Comparative analysis is a big picture of financial literacy in cases. I've coached 302 Haskayne teams to over 180 podium finishes. Comparative analysis answers, how does the organization compare to its own history and the others in the industry? This is part of the Case Finances and Excel Mastery series. Turn numbers into compelling insights. Let's break down how you do a strong comparative analysis, including debt and equity considerations. Comparative analysis means comparing the firm to its own history and to industry peers using ratios and other calculations. There are key types of analysis: horizontal, year over year changes done based on 2 year trends, multi year patterns, 3 or more years, and vertical, relationships within a single year, often done as a percentage of sales. Converting statements to percentage of sales makes trends much easier to spot. You can use CAGR to smooth growth or decline over time. It's a representational number that helps comparisons across profit, sales, investment, and even things like customer satisfaction. Always look at both the smooth CAGR and the actual year-to-year changes for the full picture. Move the insights from your situational analysis into your comparison. Answer questions in terms of liquidity and cash flow, like can they pay the bills? With profitability, how much money are they making? Stability and growth, where's the growth happening? Revenue, profit, assets, or equity? Efficiency, how well are they managing assets, turning them into cash? Things like asset turnover, receivables, inventory, and the cash conversion cycle. Compare these historical against industry benchmarks. These show where the firm stands relative to its peers and highlights the strengths and weaknesses your solution can address. A key part of comparison analysis is understanding the relationship between debt and equity. Debt is cheaper, but riskier and must be repaid with interest. Look at things like your debt ratios, interest coverage, covenants, short and long-term use, and restrictions. Things like lines of credits can usually only be used for operating expenses. Equity is more expensive and dilutes ownership and control. Consider the capacity for new equity, sources, friends, family, VCs, IPOs, classes of shares, voting versus non-voting, preferred shares, retained earnings, and shareholder loans. Industry norms vary. Some sectors are naturally debt heavy. Always factor in things like risk tolerance, tax and estate planning, succession planning, which is especially important in family businesses. There you have it, how to perform a strong comparative financial analysis, historical and industry benchmarks, plus the real implications of debt versus equity. This is part of the Case Finances and Excel Mastery series. Turn numbers into compelling insights. Drop a comment. Do you usually compare historical to industry or both when doing financial analysis? Subscribe and hit the bell for the rest of the series. Cam Welsh out, go compare to understand, and then recommend with confidence